Let's kick it off. Our second cash flow Sundays. Happy everybody's here. Today we'll be looking at all the stock market news that happened last week. We'll be looking at the coming week. We'll be doing some stock analyses, and we have some themes for the stock analyses. We'll be doing some software, the battle against the two software giants for the creators, Adobe versus Figma. Which one should you get? We'll be doing a battle for the fashion stocks, LVMH versus Lululemon. We'll be looking at some medical stocks. We'll be looking at some other stuff, and we'll also be analyzing some stocks from a sell perspective. There are two businesses that I own, and I'm interested in selling them. And I'm wondering whether now is the right time or not. And I think that's a different way of looking at the stock. Um, so that's what we'll be getting into. And the point of these live streams is as follows: we want to educate you, the retail investor, on how to look at the stock market and how to get an edge to get yourself ahead. There's a lot of information out there. You're competing against some big guys, the institutional investors, and we believe you need an edge and you need a different way of approaching it. A lot of people follow TikTok, they follow Twitter, they follow Reddit, and they take their investment advice from those platforms. And I think that's a bad way to look at investment. There's another way, there's an easier way. You can look at the business behind the stock, you can buy that, you can hold it for the long term, and that's where you can find your wealth. So that's the vision that we have when we look at the stock. That's what we preach here. If there is ever any questions on any principle or any theory we use, or if there's something that I say that you don't agree with, please let me know in the chat. If there is anything you want clarification on, or if you have your own stock we should look at, please let us know as well, and we can make this an interactive session. So let's start it off with the news. No, first off, I want to start off with the surprise of the week, as always. And I think my surprise was uh, Trump was claimed to be dead on the internet. I think that's quite funny that something like that can happen. He was offline for about a week, and then everybody assumed that he could be dead. He's already quite an old guy, so who knows? It could have happened. I don't know if it's lucky or not, but he was alive and soon back on Truth Social and putting out those tweets, or what do you call it when you go on Truth Social, uh, and getting into beef with the Fed again. And I think that's where we want to kick off the new segment as well. That's quite a good bridge, um, because we continue to have some instability amongst the Fed rate setting, and the Fed has two responsibilities. One is to keep inflation low, and the other is to make sure there is employment in the U.S. economy. And recently, there was an employment summary that released on Friday. This was released by the U.S. Bureau of Labor Statistics, and they talked about the job creations that happened in August and the unemployment rates in August. And I think there are a few headlines. The total of jobs created in August was plus 22,000, which is a relatively small number, and it has shown little change since April. So this could signify that the total U.S. economy, the growth of the total U.S. economy, is slowing down. Job creation is, of course, very essential, very at the core of your economy. People need to work, they need to produce, and the production of all the people working together, the cumulative production, will lead to GDP growth, and that will lead to the entire economy growing. So there need to be more jobs for the economy to grow, and the unemployment rate has also changed a little. It hasn't gone up, it hasn't gone down. It's very stable, 4.3%. So there's no cause for concern. There's no major chaos, but you do see slowing down U.S. economy, and this is why Trump is actively pushing for the Fed to lower the interest rates, or this could be one of the reasons why he's pushing for lower interest rates. In the short term, this could improve the U.S. economy. It could the reason why it could increase or be beneficial to the U.S. economy is because with low interest rates, it's easier to invest or to gain access to cash that you can invest into your own business, and if you that investment leads ultimately to more jobs, which lead to growth in the U.S. economy. And Trump wants to have good statistics during his term. He wants to grow the U.S. economy. That's what he says. He wants to grow the U.S. economy for the common man, and that's what he's invested in. Now he does this in a very Trump way. By going head to head with the Fed. It's an absolute clash, and he's trying to take control like we've never seen before. No US president has tried to do it like this. We've seen clashes between the Fed and the government, but Trump is actively trying to push Jerome Powell, but other candidates out as well to gain control of the entire Fed board, which contains about 12 governors, if I'm correct, and they all vote on where the interest rates should go. Now, given these statistics, that both the new jobs have slowed down, the creation of new jobs has slowed down, and the unemployment rate is relatively stable. But it's not looking too, those two together aren't looking too good. This might signify that the Fed is lowering their interest rates, but it is yet unclear what the tariffs will do and where the price changes for the tariffs will land. Because the tariffs, they will increase the price of everything, or they could increase the price. It's yet unclear where that price change will land, what the impact of that the price change will be. And I had some contact with a buddy of mine. He is a doctor in economics, and he said this is called tax incidence, and this explains who carries the burden of these tariffs. And let me draw this out for you. So we all know, or I assume most of us know, how price gets decided in the market. The P is for price and the Q is for quantity. You have a line for demand, and you have a line for supply. And where they meet, this is the price that the market is willing to pay for this. Is where they meet. That is the ideal price point. And tariffs are essentially a tax, and they will increase the cost of what is being produced. That's just a fact. But where these costs will land, that's yet unclear. But there's a way we can make this very visual. Let's say there's a tariff, and this increases the cost, so this pushes the entire supply line up, and it will look like this. And excuse my my drawing skills. There will be another intersect point. So given the supply, the price has increased. You see it has gone up, and the demand, is made at a lower quantity. And now, who will carry the burden of this increase in price? You can calculate it as follows, or you can draw it out like this. There are two different intersect points, the old intersection point and the new one, and they basically cross over. And if you follow the new line down from the old supply point, and let me use another color, this entire piece is paid by the supplier, and this entire piece is paid by the consumer. Now you can have a few different variations on this, because right now the elasticity of the demand, it's at like this, but the line can go straight down as well, and that means the entire price point is being paid for by the consumer, which is not very good. It's yet unclear how this will play out, and there's another factor that's taken into account here. But before we move on, let me draw it out quite quickly. Let's say the demand line is like this. There is zero price elasticity. This was the old supply. Let me do D for demand, old supply line. Then this is the old price point. Now with the tariffs, the entire cost of everything goes up. So this is the new supply, and you have a new line. And if we draw our little tricky parts, now all of this is carried onto the consumer, and this could be a huge inflationary push. And with this inflationary push, the Fed could act and lower or decrease interest rates to boost the economy. No, I'm saying it wrong, the other way around. They want to combat inflation, so they might increase the interest rates. And another factor that plays into this is that most businesses that sell to consumers, they could see these tariffs coming. Trump had anticipated that the tariffs would come, and there was some pauses here and there where you could stock up on supply, and therefore there's still a lot of supply that has been bought at the old prices and can still be sold at the old prices. So it's yet unclear how this will carry over. Maybe the tariffs, the price impact for the consumer could be relatively low, but that's still unclear, and I think that's something that the Fed is still looking at. And it's not strange for them to wait this situation out. So I think that is the entire Fed part, and the employment situation over in the US. It's something to keep an eye on. Now, this doesn't majorly impact my investment right now, but it's a temperature gauge into the market. You want to see how healthy is the market today. And right now it's saying, yeah, there's some good, there's some bad. It is relatively stable, but there are no real signs showing serious growth. There are no real signs showing serious decrease. So it's something to keep an eye on. That's the way I look at these things. It doesn't really warrant an entire flip, whether I want to sell or buy everything. And it's never good to panic, but it's good to be aware of what's going on. What plays into this as well, and what I find very interesting, is that well, this is another side of the inflationary report. This is a Yahoo Finance article. I find this quite interesting as well because they're very, very, very negative, and this is something that have to be mindful of when you look at the news. It's very easy to get dragged on in the hype of a headline. They call it a dramatic slowdown, but I wouldn't call it a dramatic slowdown. It hasn't changed since April. The amount of jobs added is relatively low, but the employment rate is absolutely stable. So this is a gross over-exaggeration of the actual climate, of the actual US economic climate. So whenever you see headlines like this, don't get dragged away too much by the hype created by the news outlet. Their job is to sell you the news article, and it's less about the facts and it's less about the actual information that you can use. So tip of the day: be mindful what you read. Tariff incidents, yeah, we talked about this. Now we have shown on the consumer side what it could do to prices. Now on the seller side, you could split it up in two parts as well. There is an importer and an exporter, and historically it is shown that most of it goes to the importer, the burden of the tax incidents. And this talks about 40% of tariff increases are passed through to the consumer if you look at the historic data. So there are different price lines for each different product category, and across the whole economy, it's about 40% of tariff increases are passed through. 40% is massive, especially with the tariffs that Trump is announcing right now. There's another great article that was sent over by the doctor in economics. Thank you very, 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 very much. I won't go too much detail into this. I haven't read all of it, to be honest. But it has a nice historical outlook on what happened over the years and how many U.S. presidents have actually implemented tariffs. So if you're interested, go have a read. To what extent do you still think these numbers are real labor numbers? There's a lot of controversy with Trump fixing the numbers. Yeah, I think you can't trust well, to disregard everything as fake news, I think would be wrong. To take them with a grain of salt, in my view, is the right way to look at it. I can't fact check whether those numbers are right or not, but you can look at the trend, and even if the numbers are wrong, everybody looks at those numbers and interprets them in a certain way. So the fact that these numbers are published and how everybody reacts to the publication of these numbers, regardless of whether they're true or not, already tells you something about how everybody treats the economy. But my view would be take it with a grain of salt. And I think it's a Trump effect. He is kind of altering what we call the truth, and that's not a great thing. I think what's interesting to link to this is that you see that the dollar is tanking. That is the market reaction as a whole. Not only in the stock market, but I think mostly in the bond market. People are taking an alternative to the dollar, and usually, if you want to invest in the dollar, or if you want to have a dollar backup, you buy the treasury, so you buy the U.S. debt. You see a massive increase in the gold price. You see a massive increase in the silver price. The gold price has gone up. I'll explain this graph later, but the gold price has gone up quite a lot. And this is mostly the reason for this is because central banks are buying gold as a backup, as a reserve currency. US dollar used to be the reserve currency, or it still is the world reserve currency. But for safety, most are looking at other things to have a safe haven for their cash. And gold is historically a safe asset. And with the gold price rising, it shows that the trust in the dollar is lowering. The total value of the dollar in relation to the euro has also lost its value. So I think that's a reaction to actual market reaction to Trump altering the truth, altering these kind of numbers. And the graph you're looking at now shows the relation to gold to silver price. Now, historically, this has been about it sits around 50 to 60 for each ounce of gold. You can buy 60 ounces of silver, and it has this is a 10-year graph, and since 2021 gold has continued to shoot up in price in relation to silver, and only recently you have seen that silver has begun to catch up. The gold price has not actually decreased, but the silver price has increased, and I think silver as a material has more value than just gold. The reason why I'm interested in this as well is I own a gold and silver miner, and the gold price has shot up, and usually the silver price takes a little longer to catch up, and you see the silver price catching up. Another way this ratio could be altered is by the gold price dropping. But historically, if it's above 60, it means that silver is relatively cheap and gold is expensive, and the inverse is true as well. So one of those can still go up, and with it slowing down, it could be a good signal to sell. But we'll be looking at the business in detail later on. But this is the backdrop for that story later on. Any other questions? Any other things we should look at? I think I want to discuss one more thing, and that's the stable coins. A little cryptocurrency talk, but the US backed stable coins have taken a flight since Trump signed the Genius Act, which was not named after him, obviously. And this allowed, it allows stablecoin producers to produce stablecoins, and the stablecoins are backed by actual dollars. And actual dollars, they're backed by US treasury bills, or by the T-bills for short. And what this does, it creates a good incentive for US. I think most of them are US creators of these stablecoins to buy treasury bills, and the US debt is mostly owned by China. Japan is it's owned by countries that are not the US, and even economic rivals, and that has its own risk and tail to it. It's quite clever to turn this around like this. Having your own stablecoin producers that are backed by the dollar buy up your treasury bills. This gives you more control over your own debt, and it also increases the demand for these treasury bills and could therefore lower interest rates, which again is in Trump's favor. It also becomes easier for everybody to hold the dollar, and it strengthens the dollar's value as the world's reserve currency. It's very easy to transfer these currencies. The dollar could still be relatively slow, especially interbanks across countries. And these cryptocurrencies could be a lot easier to transfer, so there's some liquidity efficiency there. For the US, it generates more control over their debt, and it creates more supply, and therefore could lower interest rates in the long run. Now, there is of course a little bit of a risk, because how seriously are these securities backed by the dollar? How serious is the oversight and control on the dollar backing for all these securities? If this is not up to par, you're very rich, you buy all them up, and then you try to sell them all away and exchange them for dollars. And there's no liquidity on the other end, because they maybe try to get creative with it and invested all their dollars somewhere else to get a little bit more return, but therefore lose liquidity. And if they can't pay out, then the whole thing collapses and it could go to zero. So I think it's yet to be tested, but for now it's an interesting development, and it puts stress on other countries as well, because it becomes easier to hold the dollar as a reserve. The ECB, the central bank over here in Europe, could have less control over its own monetary policy, because more and more is being done in the dollar. So there's less euros around, and therefore less control for them to take hold of. Monetary policy can be quite interesting, but I think we've covered our economic session for now. I want to have a quick look at what's going on next week. There is some consumer credit report coming out on Monday, September the 8th. We'll be looking at the August producer price index. This is interesting to see as well, more inflation numbers. And that's interesting information for the Fed. And to I'm not really in the prediction game. I'm not really trying to predict where the Fed is going to go. But the Fed decision usually has an impact on the market, and it could be a good time to buy or to sell something. We can look at the August Consumer Price Index, again another inflation report, and September preliminary university segment. I don't really care. We have Oracle numbers and Adobe numbers, and we'll be looking at Adobe later. Ooh. And then we can look at it again next week and see if it has improved or not. So that's what's coming up next week. Now, that's for the entire economic section. Let's move on to our stock analysis. And I've quite a list. There are a few stocks that I want to take a look at. We already saw Adobe, so maybe let's start out there. All right, Adobe currently at 350 out and about. That's a price. We see a price graph intraday. Let's look at 5-year price. A little up, a little down. Now, when we do a stock analysis, we want to answer 3 basic questions. We want to see, is it a great company? Can we get it for a great price? And can we reliably predict it for the future? Now, when taking into account the first question, is it a great business? One thing that I find very important to look at is its liquidity position. And if you hear liquidity, think cash. The reason for this is cash allows a company to invest in themselves, to buy other businesses. If the business is going slow, they can use some cash to make sure they stay afloat, they don't go bankrupt. So it's a great starting point to assess whether a business is great or not. If you look at the cash side, you also want to look at the debt side. And the debt is kind of the conscience of the company. They can increase their cash, but if the amount of cash that has been created is equal to the amount of debt that has been taken on, it's a net zero game. So you want to check if both are in relation to one another. And a quick way to do this is if you go to the cash flow statement, the balance sheet, and we look at you want to look at their short-term cash. And I think short-term investments, this could be treasury bills. You want to take those into account. It's about 8,000. And if we scroll down a bit, we want to look at short-term debt, which is about 1,500. So they have way more cash than that they have short-term debt. The reason why we look at short-term debt is because you have good debt and you have bad debt. And bad debt is usually the short-term kind. The interest rates could be lower, but they're also due earlier. So you want to be sure that they can pay the debt that is due the earliest. And long-term debt, a lot of the time could be capital leases. And a good form of that is to have a mortgage or to have a lease on a building. So we are a little bit more lenient on that side. Okay, so it meets our first check for the liquidity. Next up, we want to take a look at cash flow and whether the business is operationally efficient. Now, what does operationally efficient entail? We want to make sure that from everything they sell, they can keep a high amount of cash. And we don't look at EBITDA. The reason why EBITDA is something that's invented by private equity, and it's only there to sell a business for a higher multiple, but it doesn't tell you actually anything about the quality of the business, or it can tell you something, but it's very easy to manipulate. So whenever you hear EBITDA, think bullshit earnings. You want to look at cash. Cash is what you can actually use as an investor. Cash is something that the business can actually use. So that's what we want to take a look at. And if you don't want to dive too deep in all the cash flow statements, you can look at the margins. And Adobe is a perfect case of why you want a software company, because they have very, very high gross margins. 90% means that on every $10 that they sell, they get to keep 9. That's a really, really high number. We'll be looking at more stocks today. Keep in mind, 90% gross margins for Adobe, for a software company, that's very, very good. And the reason why this is very good, if you have let's say you have a factory You need to pay for the raw materials. You need to pay for the electricity. You need to pay for all the labor. And with every factory that you add, you also increase your cost base. Now, if you have a software product, you can have the same piece of software and you could sell it to 20 different companies without having to increase your cost base at all. And that's why the gross margins are very, very high. Now, gross margins do not yet give you cash. For that, you want to look at the net margin, which is about 25% or 26%, which is still relatively high. And if we want to take a look at our cash flow, this is where you can see the cash actually coming in year to year to year. And we want to see this number grow. Ideally, you have a growing cash flow. It started out in, what is this, 2020, 2021, just under 7,000, 7,400. Then it dipped a little bit, and then it grew. It's relatively stable. Capital expenditure is their expenditure in increasing their production, which is, for a software company, it doesn't need to be very high. So the cash flow is relatively stable. Now, if we increase the periods that we're looking at, and this goes all the way back to 2015, then we see a massive growth. But over the last 4 years, this growth has slowed down. Ideally, you want a stable free cash flow and a growing free cash flow. The free cash flow is very stable. We don't see any negative numbers. We don't see a high variance. Growth used to be there, but right now it's stable. Another thing we want to look at is their increase in revenue. Now, again, we look at the past 10 years. It started out at 5,000 and it is more than 4 times higher, more than 4 times higher, 21,000. Now, this is very good growth. And you see that the growth, that both their revenue is very stable and that the growth is there. The last few years, it has slowed down, which is not a strange thing. Their revenue, this is in million. So this is $21 billion in revenue. As a company grows more and more and more, it grows bigger and bigger and bigger. It becomes harder to keep that exponential growth curve in there. So this is a little bit of the growth is there, but it's slowing down. And if we take a look at our little graph, it's not actually too bad. Over the 5-year average, it's still about 14%. And we saw that on the September 11th, they're going to release their new earnings. I'm very interested if they can continue their revenue growth for the first 2 quarters of 2025, as well as continue their free cash flow growth, or rather pick up their free cash flow growth again. You can see that the 5-year average was around 11%, but their 3-year average has significantly decreased. And on the revenue growth side, you see that the 5-year average is higher than the 3-year average, which shows that slow growth is slowing down. Then what you want to look at next is what can they do with their cash? Can they invest it against higher returns than you yourself can invest it in the stock market? Now, I aim at least 15% return. So I want to see a higher than 15% return on my cash. And they don't show that. They have 14.42%. Last year, it was even worse. So we truly see a business that used to grow very, very rapidly that's absolutely slowing down. Their cash situation has improved. No, it hasn't. Over the 5 years, it was higher than the last year, so they've spent some of their cash. But this is a healthy number to have. And what they do with that cash is they do buy back shares. Now, I always am happy to see share buybacks for a company that is slowing down growth, that has a lot of cash, and they want to invest it somewhere where they can get a good return, and they invest it in themselves, limiting the total amount of shares, therefore increasing your total share of the pie as a shareholder. So I see some good things, some bad things. I don't think it's a great business. It's just okay. It's not great. But price matters. So if we can get it for a cheap price, it could still be a worthy investment. So next up, we move on. Can we get it for a great price? Now, what makes up a great price? We've already decided that their growth is slowing down. They used to be a very high growth company. If they are a high growth company, you want to pay. You're willing to pay a higher multiple on their earnings, and that multiple is called the price to earnings, or PE ratio. And for Adobe, you're paying 41.5 times their earnings as a share price. And market average historically is about 15. This is more than twice as high for a company that has slowed down growth. On the face value of this, I already would say this is not cheap at all. Price to free cash flow, for free cash flow, that is, yeah, it's growing, but it's not worth 30 times price to free cash flow. And another way you can kind of look at a business, whether it's overvalued, undervalued, or you're paying more or not, whether something is a great price, you want to get a yield that's higher than the interest rate, or that you could get if you just put your money in the bank and you take on no risk at all. So the no risk rate is relatively equal to what you could get if you buy US Treasury bills, or if you put your money in a high interest savings account. And right now that's higher than 4%. I'm not actually sure what I can get right now. In the US, it's a little higher. Over here in the I live in the Netherlands, it's a little bit lower. So 2.41 is higher, but you're taking on more risk. So I would want a higher margin of safety. I would want to be able to get paid more and therefore have a lower share price for it to be a good investment. Right now, you're taking on quite a bit of risk. You're paying for growth that's not there. So on the face value of it, it's not cheap. It's not cheap at all. They don't pay a dividend, so there's no cash flow that you can reinvest yourself. So I would say it's not cheap. It's not a great business. And then the last price is the predictability. It's very, very stable. It has shown very stable revenues, even though slow growth is slowing down. It has shown very stable cash flow generation. And it's also very clear what they do with their cash. They have low amount of debt. They have high amount of cash. They buy back shares. So I would say predictability is great. For me, for this to be an interesting investment, the share price would have to, well, almost half. It has to be closer to 15. It's not there right now. I don't see it going there anytime soon, maybe after the earnings. But now I want to take a look at another stock that's closely related to Adobe, because Adobe dominates with their product line, or they used to dominate the entire creator market. Everybody who does anything with video, with photo, with audio, they all use the Adobe suite. Adobe is very smart to target students, and whenever they get you locked in, they grab you by the balls and they never let you go. So everybody keeps buying Adobe. They keep buying into their ecosystem. Everybody gets used to using Adobe. And I've worked in a big software company, and everybody that was used to using Adobe, they didn't want to switch. They didn't want to switch at all. So if they have a very good moat, it makes them a very strong brand. It makes them a very strong business. You could be willing to pay a little bit more for that. I think where the times are changing quite fast with AI and all the new tools that are coming out. So I think that moat, I value it a little less. And one of those new players is Figma. And it has recently IPO'd. So there's not a big stock chart to look out for. It IPO'd a little before August 2025. I'm not entirely sure when they IPO'd. Let's look it up. IPO Figma. Is what, the 31st of July. I'm not entirely sure when they IPO'd, but looking at all the headlines, it wasn't very successful. And we already see quite a significant drop. But again, let's take a look at it from the basic three questions. Are we buying a great business? Are we paying a great price? And can we reliably predict it for the future? Now, first up, is it a great business? We want to look at their balance sheet, see how much cash they have on hand, about 1,500 cash and short-term investments. If we set that off to their short-term debt, their cash position is looking nicely. If we look at our income, the only 2 years we can take a look at. Let's see if we can get some more data. If we look at the quarters, it has, can we say it has doubled over 2 years? Less than 2 years. Less than 2 years, it has doubled. That's quite good growth. It's not exponential, but this is something that you would be willing to pay a higher multiple for. Now, if we look at their cash flow, are they cash flow positive? They used to be cash flow negative, but they've turned it around into cash flow positive business. Now, to say whether or not this is stable, I think that's too early to call. But you can't tell there's growth both in the they're going from -20 to +60 in only 4 quarters. Uh, mm, 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 mm. They've recently announced their earnings, so this is quite recent data. So there's nothing being added to this. Okay, so I think from this perspective, it's looking okay. Are they operationally efficient? Again, this is a software business, so gross margins are very high, lower than Adobe, but the amount that they can keep in cash is a lot lower. For a growth business, it's not too difficult. Or we can explain why this is extremely negative. They probably reinvest all this money back into themselves so they can keep growing the business. Yeah, these graphs, they're not yet very informational. We have very few amount of data points. We do see revenue growth. Free cash flow growth is not too great, but this is only up till 2024. The 2025 quarter data is not yet in here, which was positive. Return on invested capital is still negative, so yeah, you see growth, but irrelevant. Their most recent return on invested capital still -60%. Cash to debt very high. For a growth business, you like to see this. They need to be able to pay for their expansion, and with a big pile of cash, that's relatively easy to do. So this is what we like to see. They also hand out shares. Ideally, I want to see share buybacks, but for a business that's still very young, that has just IPO'd, that's still growing, them handing out more shares in order to get more cash without taking on debt, which they seem to do, is a great business strategy. Now, if we look at what they actually do, and let's see what their recent earnings calls, how the management talks about their business, they make tools and product teams for product teams and designers. They're also a subscription-based business model, and they earn money through licenses and product offerings, very similar to Adobe. I think the Adobe suite is a lot bigger. The Figma suite is a lot smaller. As user base can grow, they can add more products to their business lines. They have a strong community in product innovation. They hosted 10,000 community members at their Config conference. They build loyalty and brand strength. Modifying payloads. Yeah, they're already increasing their capabilities by doing mergers and acquisitions from modify and payload. They try to do basically what Adobe did or still does, creating community by making sure people buy into the brand and stick to it. And then they can keep selling their licenses, maybe increase the price a few times, and then Figma basically becomes Adobe 2.0. Their growth ability, their revenue grew 41% year over year, reaching 250 million. Now, this is still relatively small if we compare it to Adobe, which had 21 billion. 250 million is only a fraction of that. They launched 4 new products, doubling their offerings. That's quite significant. Their commitment to evolving customer needs. They're focused on AI. Everybody's talking about AI. May reduce margins because they need to make investments, but positions them for future growth. Now, Adobe is also investing in AI, so to me, this is not really a defining characteristic for Figma, something that sets them apart. It is not. Future expectations. Management emphasizes long-term growth through AI investments. They believe AI will transform software development workflows. I do agree with that statement. Figma's revenue growth. They're investing heavily, blah, blah, blah. Community engagement is robust. Yeah. I think it's too early to call it a great business. They're not yet profitable. If we look at their net margins, negative EBITDA, again, bullshit earnings, but negative, so not too great. They do have a lot of cash, so there's room for growth. In my mind, it's a little early to buy into it. The price has dropped significantly, but it's very hard to value currently. What are we paying? Net income, revenue streams. Yeah, revenue is positive. Earnings per share was negative. Look at it from a yearly perspective. I think 2024 must have been a negative year, and they've already this quarter seemed to turn it around. And I do find that to be interesting because they've gone from a negative earnings per share to basically already in the last quarter of 2024 to a positive earnings per share, except it went back down to zero. Yeah, I think this is something that you can put on your watch list, take a look at every now and then. Right now, it doesn't scream that it's very investable to me. Um, is it a great business? I don't think so yet. It's very hard to price effectively, so I can't say whether it's a great price or not. And predicting it reliably for the future is also very hard with a small business. Growth could slow down. The whole AI boom could produce an entirely new player taking away market share. Adobe is still the big boy to beat. They are closing in, but they're not yet in a position that they can confidently say they're beating Adobe. Uh, I still think Adobe has a stronger market position than Figma, and that gives them more avenue and some maneuverability, even though bigger companies are less maneuverable than small ones. So to me, this would be something to look out to, look for, yeah, keep on your watch list, take a look at it every now and then, maybe at the end of the year, see where it's going. Right now, it's too early to call, but interesting to look at. And there is another player in town, so Adobe, watch out. Next up, I want to take a look at two fashion stocks, and let's start out with LVMH. A little bit of French business. Je t'aime. My wife is French, so I have a little predisposition towards the French, even though from a business side, I hope she doesn't hear me. They're quite not too good. Okay, again, same three questions. Can we buy a great business for a great price, and can we reliably predict it for the future? First up, the debt to cash situation. Cash and short-term investments, we're looking at about 13,500 in cash and short-term investments. If we compare it to their short-term debt, okay, they can pay off their short-term debt. It's not the best cash to debt position, but it's still positive. So I'm happy to see this. I'm okay with this. Next up, let's take a look at their cash flow statement for the last 4 years. Yeah, it's going like this. If we add a few more periods to this, we see significant cash flow growth. So they managed to increase their revenue, and from that revenue, they can keep more cash. And this cash flow they can reinvest into their business. And we'll be taking a look at how they reinvest it. Do they buy back shares? But right now we see a growing cash flow from the beginning of the period we can look at. It's grown quite significantly. But the last 4 years, yeah, this year to this year is still growth, then massive growth, and then it has slowed down, and it looks like it's picking it back up again. If we take a look from a quarter, there's no 2025 data yet, so that's not too interesting to look at right now. So cash flow relatively stable. Let's take a look at our income. Continues to grow. 2023 to 2024 was a slow year for them. Their cost of revenue, it has increased slightly from here to here, and the gross profit has dipped, so they've become a little less operationally efficient. Their cost has increased more than their revenue has increased, or their revenue has decreased. So that's not too surprising. Look at the EPS. Yeah. Are they operationally efficient? Now they do get to keep about 15% in cash. Let's look at their return on invested capital, which is 10 plus. That's quite good. Again, ideally, I like to see something in the 15s, but if they do share buybacks, that is another way your stock, just your ownership, your stake of ownership in a business can increase. This is not a bad thing to look at. Will we see some revenue growth? Last year was tough. The 2025 data is not yet in here. If we look at the last 5 years, it has been great. And then more recently, it's been down. And this is something I love looking at. I like a business that has a very direct problem that pushes the share price down. And then your job as an investor is to find out what that problem is and if this is something that they can solve in the short term, yes or no. If they can solve this in the short term, it could be a great investment because your share price is dropped. The risk, if the price drops, there's less room for that to fall and there's more room for that to go up. So your risk has decreased if you buy a great business at a great price that you can reliably predict for the future, if you can answer all those three correct. So a depressed business that has a solvable business problem is a great investment case. And right now we see a business that has shown really good growth, but recently is experiencing decreasing growth and even a revenue decrease. The return on invested capital is also decreasing, but still around 10%, so not too bad. Their cash position is great and remains great. So from a liquidity perspective, they're doing good. And they are buying back some shares. And it seems like the share buybacks have increased, which is great because the share price has dropped. And that's what you want to see. If a company does share buybacks, you want them to buy back their own shares for low prices. So if the stock price is down, that's a great opportunity for them to buy into their own business. Let's see if they talk about their own challenges and how they look at the future. This is our due diligence is our AI algorithm that screens all the last earnings calls. It takes all the important information and the sentiment that's being discussed on those earnings calls, and it summarizes it to you as a retail investor to look at and to see if this is a business that's worth your time. Now, never go out and buy something because somebody on the internet says it's a great buying opportunity. Never ever do that. Don't buy something because I tell you to buy something. Always do your own due diligence. But this tool allows you to quickly scan if a business is worth your time or not, whether it's something you put on your watch list or whether it's something that fits your investment criteria and that fits your style of investing and that fits what you want to reach for your financial future. Now, if we look at our due diligence, I think most of us know Louis Vuitton, luxury goods like fashion, cosmetics, wine, for affluent consumers. And a lot of those affluent consumers are in China, and the Chinese economy is slowing down. So I think that's where their problems arise. Their business model is built on exclusivity and brand prestige. They earn money through high margin products and selective retail investments. LVMH has a strong brand portfolio, including Louis Vuitton and Christian Dior. These brands maintain high quality standards. I think we can all agree this is still very true. This creates quite a nice moat. They had a 3% revenue decline in the first half of 2025. Their operating margin remains robust. Now, that's what you want to see. If their operating margin remains robust, it means the business can still continue to operate, even if growth slows down. So I'm not yet sure whether we can call it great business, but it looks like a great business in the making. The company shows compounding momentum, especially in fashion and leather goods. 19.1 billion in yen. They're doing some big numbers, despite a 7% organic decline. They focus on product innovation and strategic investments to drive future growth. They expect a recovery in wines and spirits. Yeah, it's expected, but not yet realized. They're optimistic about long-term growth. They usually are. They emphasize structural efficiencies to boost profits when market conditions improve. I think that's a great way for them to position themselves. They can't really influence whether or not the entire market or when the entire market will improve, but they can position their business in such a way that it's that is run very operationally efficient. And as soon as demand picks up, they can produce the quantities necessary at great margins and therefore massively increase their own cash flow. And that could be a great investment case. They also highlight strong local demand in Europe and the US with an expected rebound in mainland China. And China is a key factor here. Revenue fell 3%, but margins remain strong. Okay, that's nice. Fashion and leather goods still dominate. Okay. Yeah, I think this is a great business. It's a very strong brand. They have a good cash position. They are very low debt. Their return on invested capital is great. They buy back their own shares. They've shown free cash flow growth across the last few years. If you look at their average revenue growth across the last few years, this has been positive, but it is a company that's in a slump. And it's a great business, but then it becomes more important. Can you buy it for the right price? If you can buy it for the right price, you can wait it out. And if everything improves, then you currently see growth pick up, your multiple could pick up, and you could look at a great investment. And it's a great business. Is it a great price? If we look at a PE, you're paying a multiple in relation to the earnings of 25. And their growth over the last year has been negative. I would like that to be a little bit lower. The same for the price to free cash flow. Their yield numbers are around 4%. In Europe, the interest rates are around 2% currently, so that's your risk-free rate. They're a little higher, but not too much. You do get a dividend. There is the added compounding effect of them buying a little bit of shares. It's not really enough. Let's use our discounted cash flow analysis. And here we can calculate whether something is overvalued or undervalued based on our own assumptions of how the business is going to do in the next few years. Now, we have seen 18% revenue growth in the past. That's the business record, but we already see this is being depressed. So we do a 10-year analysis. Let's say for the next 5 years, it continues to be best case scenario. Let's say in the next 2 years, there is no growth, and then they manage to go back up to, let's say, 15%. So let's average it out to 11. For the normal case, I think 5 years, maybe no growth, slowing down growth, and then it could be around 8%. And the worst case, it's not going to pick up at all, and they only manage to grow 3% year over year over those 10 years. I want to pay an exit multiple of around 15, 10, and 5. I'm willing to pay market average for 10% growth. I think that's fair. If they show less growth, I'm willing to pay a lower multiple. And if they show barely any growth, I'm not willing to pay much at all. And I do want to keep 15% return. Now, are these fair assumptions? I think we can correct this up a little bit more. Let's go to 12, 8, and 4. And then let's go to, no, we keep this like this. Boom. 154. Currently is 500. It's still overpriced. So great price. No, could be something to put in your watch list. If the price continues to drop, I'm willing to buy into this. If we look at predictability factor, you are dependent on China and whether or not the economy there picks up. You are dependent on fashion trends, and that's not my strong suit. I'm not too good at predicting what would be the next big bag to buy and where the fashion trends in the future go. So if you can, this might be an interesting thing. And the third thing is whether or not you can predict whether they can be operationally efficient and they can, with a decreasing revenue, keep afloat. And I think that prediction for me is a little easier to make. You see, they already keep their operational efficiency very high, even though they sell less. They have a lot of cash. They manage to buy back shares. So I think on that part, it's okay. But from a predictability perspective, there are too many factors outside of their control to really reliably predict where this exact business is going to go. And I think LVMH is currently downbeaten. They've been a lot higher. I think their moat used to be extremely strong. And I think that's why people are paying a high multiple for it, even though there's currently no growth on the revenue side. This is something to be careful of, but to be interested in. And as Warren Buffett always says, be greedy when others are careful and be careful when others are greedy. And right now, I think people are not careful enough when it comes to this stock, and I can wait being greedy. Now, one of their competitors, LULU, which is another fashion stock, is also down a lot. And I've recently read an article in the news about the decreasing interest in athleisure wear, as it's called. During COVID, this entire fashion phenomenon increased. Everybody wanted to walk in leggings all of a sudden, and Lululemon apparently was the brand of choice. and they have become less popular now, and therefore they are down on the market. And to me, if you look at it through the lens of that news article, it seems that the fashion trend has decreased and therefore the stock price has decreased. And what I usually see is that the stock or the news follows the stock and not the other way around. So if the stock drops and we see decreasing revenue growth, then you see news outlets looking for an explanation, and then they come up with something like this instead of it happening the other way around. They see a changing trend, they report about it, and then you see the stock price drop. Now, why is this important for you to know? It's very easy to get taken along in the hype that's being created by media outlets. Don't do that. Do your own analysis. Look at the business. Um, it is a great way to look at businesses that are depressed. And like I said before, I like cases where a business is depressed, but they can turn it around. It could be a great investment case, exactly because it's depressed, and that's a contrarian view. But as a value investor, I think that's a very good way to look at the stock market, to look at your feed and see the world through that lens. If you see something down, that's exactly at that point. That's why it's interesting to look at the business and see if they have a problem that they can turn around. Let's see if the business is great, if you can buy it for a great price, and if you can reliably predict it for the future. And that's where our software and our community comes in to help you making that decision. Now, once again, we're going to ask our 3 questions. Is it a great business? Can we buy it for a great price? And can we reliably predict it for the future? And we've just looked at LVMH and now Lululemon. Let's start out with our growth statistics. They show more growth. They don't show a decrease in revenue, but they do show decreasing growth. Over the last 5 years, they've grown about 25%, but they had crazy good years coming from COVID. And currently, they're still growing 10%, which is great. Their free cash flow has grown exponentially. And last year it's negative, and then 3-year average is at 200. Okay, I'm already getting a big question mark. You see some dips and some gains. It doesn't look too stable. The return on investment capital is very, very high, above 15%. That's what we like to see. And the cash position is also very good. And they buy back shares way more than LVMH. They have a better cash position than LVMH. They have higher return on invested capital. They have a higher free cash flow growth, and they have higher revenue growth. So from the outset, this looks like the better business to buy. But let's dive into the details. Their most recent return on invested capital was even higher, 28%. Their net margins are about 18%. Their gross margins are 59%. Now, for a producing company, this is still relatively good. We just looked at some software businesses. We looked at Adobe and Figma. They were around 90, but that's for software. Right now, we're looking at fashion brands. LVMH, I'm not sure what their gross margin was, but they had a net margin of 22%. And we see here a net margin of 17%, which is a little bit lower. But if we look at other statistics, I still think it's a relatively good business. Cash to debt is high. Usually you would want to see it a little bit lower, but because they buy back their own shares, they seem to be able to spend this cash in a good way. And I think for a fashion brand, that can be, if the fashion trend turns around, you can have a bad business, and then having some little fat on the bones to get you through the hard times might be a good business strategy. And they don't pay out a dividend. They manage to grow their own business, so I don't really need a dividend. Their return on invested capital is higher than 15%. Now, if it would be lower than 15%, I would be interested in a dividend, because that way I can reinvest the money for a higher rate of return myself than they can get out of it. But because they have a high return on invested capital, I'm not too worried about having a dividend, yes or no. Okay, let's start out with the balance sheet and look at the short-term investments. About 2,000. And if we take a look at their short-term debt, 275. So they can almost 10 times over pay their short-term debt. So from a liquidity and solvability perspective, great business. Let's look at it from a cash flow perspective. Let's add a few years, a few periods, and we can see year-over-year growth, decrease, growth, really big growth. This is probably the COVID year, 2022. Yeah. And then it went back to 2020 numbers, and then it managed to grow exponentially, and they managed to keep on to that growth for the 2025 financial year. Yeah, the first half. Mm, Quarter to quarter, you see it fluctuate, but this is a fashion brand, and each quarter has its own uh, has its own peculiarities. I would expect their last quarter to always be their best quarter, their first quarter to always be their worst. You have extreme seasonality in these numbers. So seeing some fluctuation from a fashion brand, it's not a bad thing. It's not a bad thing. So overall, I think the cash flow is growing. It's relatively stable. So from this perspective, I'm happy, and I think we can call this a great business. Now, if we look at it from a price perspective, can we buy it for a great price? Now, once again, if we look at price to earnings, this is about 28. I think LVMH was about 40, which is crazy high, if I'm correct. No, LVMH was 25 as well. And Lulu is 28. So this is higher, but you do actually get growth, both on the revenue side as well as on the free cash flow side. They have a higher return on invested capital. So I'm willing to pay a higher price for their earnings. And this high multiple doesn't scare me too much. They don't pay a dividend. Their earnings yield not very high. Free cash flow yield is not very high. Maybe this is about fairly priced. Let's put it into our value versus price calculator, or DCF calculator. Now they've managed to grow about 26%. Let's say they can keep up growth in the double digits, high double digits, in the 20s. Then they average out about 15, and then they go to 10. And then we're willing to pay a little bit more for this. This is market average, and then we're willing to pay a little less. No, I think I'm willing to pay 25 for 20% growth over 10 years, for sure. And then this would go to 20, and this would go to 15. I'm aiming for a 50% return. Boom. It is currently priced at 167. Yeah, we have about 100% upside given 10 years. So I think it's undervalued. I think we can buy this for a great price as well. Now, from a predictability perspective, in my mind, this is a lot easier to predict. It's the US market. It's a lot closer to home. They also sell here in Europe. I think that's easier to understand. They're less dependent on China, or they might not. I don't think they sell a lot in China at all. To me, that makes it easier to predict. I think you still see growth. They have a good cash position. They buy back a significant amount of their shares. I think this is a stock I would put on my watch list, and I would want to investigate further to see if it actually fits my criteria. Right now, it's a great business that we can buy for a great price, and that we can reliably. There's still the fashion element. I'm not a fashionista, so it could be quite. There could be another competitor on the rise that I don't know about that could take over a large share of their market. But right now, I think it's okay. Uh, it's not entirely the stock for me, but I'm going to put it at my watch list for sure, for sure, for sure, for sure, for sure. Maybe if it drops a little further, has it already? What did it do year to date? It dropped about 54%, and it continues to decline. Now, once again, price matters. Usually, fashion is not my market of choice, but I think given that this company is currently in a decline, it can quickly turn around, and that could be they could have had a few bad quarters, and I think Q4 usually for these type of businesses would be their best. It could be an interesting play. I think I'm going to put it at my watch list, and let's see at what price it's currently on there. Lulu is currently at the current market price. I want to put it a little lower. Let's say if it goes to 120, then I become more and more interested. All right. So we looked at LVMH. We looked at Lululemon, and we already managed to find some differences. Even though on the outset, if you hear Louis Vuitton, you might value it a lot higher than Lululemon. But if you look at it From a business perspective, I think Lulu is the better business and is the better stock to buy on the surface. Now, once again, don't go out and buy something because I tell you to buy something. Do your own due diligence, look into it yourself, and buy something because you believe it fits your process, it fits your risk profile, and it fits what you want to achieve for your own portfolio, for your own financial future, and your own financial freedom. And once again, our software allows you to get all the information you need, and also here over in the community, we can answer all your questions and help you reach your financial goals. Next up, we've just looked at the software side, we've looked at the fashion side, and we've looked at two businesses, or four businesses in total, but two cases where we're looking at it from a buy perspective. Now, I currently hold Alphabet, and where is it? I think Google. I currently hold Alphabet, and I think it's overvalued. So I want to see if it's ripe to sell. And I bought it, I typed it so well, around 90, which was around 2023, around here. And it's currently 235. So it's up quite significantly. And to me, I think this is a little overvalued currently, and it could be a great way to de-risk my entire portfolio and basically sell the business and take out some cash that we could reinvest, possibly in Lululemon, or have a few other stocks I want to take a look at. One of them is Accenture, another one is a healthcare company making cutting edge cancer medication. And now we want to look at it from another perspective. When I bought it, I already said, okay, this is a great business. I bought it for a great price, and I could, at that point, relatively reliably predict it for the future, mostly because I could buy it for very cheap. Now the price is absolutely off the charts. They're currently at their all-time high, or near their all-time high. Yeah, no, they are at their all-time high. So we're in uncharted territory. We don't know how high this can go. It was very downbeaten because of everybody talking about ChatGPT and AI taking over and Google search being dead in the water and being replaced by ChatGPT. They've continued to show good growth numbers. They've continued to show that they can actually make money from their users, whereas most AI models have not yet found a way to reliably generate cash for themselves. But I do see the future around the corner. How much more can they grow? And is this the best investment for my cash right now? Is there not a better opportunity for me out there? The business is no longer depressed. It's doing great. Let's take a look. Now, if we look at our due diligence, they make search engines, cloud services, and AI products. Their business is built on innovation and technology. They earn money through advertising, cloud services, and AI solutions. Their competitive advantage, they have a strong moat. Yeah, Google is a verb. Everybody knows Google. I think there's no denying that their moat is strong and still going strong. Their AI models like Gemini are widely adopted, giving them an edge. The earnings call highlighted robust growth. Take a sip. In search and YouTube, driven by AI features that enhance user engagement. They are positioned as a leader in the digital space. Alphabet shows impressive compounding momentum. Google's cloud revenue run rate exceeds 50 billion with a 17% operating margin. The earnings call noted significant growth in YouTube, especially with shorts and sports content. Their focus on AI integration across products promises sustained growth. Management emphasizes expanding AI. This is interesting because the current winners of AI are NVIDIA and most data service centers. And Google is on the software side and on the delivering of their AI product. Now they have managed to commercialize their search engine and make a lot of profit in doing that. But on the AI side, it requires a lot of investment for them to make it profitable. And this could mean that all their cash is being pumped into their AI capabilities without direct return for me as an investor, as a stockholder. That comes with short-term risk of not getting any money on your investment, but for the long term, they could still position themselves as one of the biggest players. So I'm still quite torn whether I should watch how this case plays out, or whether I should cash out now and find a better investment. They plan to enhance AI mode and integrate AI into more services. The earnings call hinted at strong demand for AI-driven solutions, indicating a bright future for Alphabet as they continue to innovate and adapt. Yeah, they're heavily investing in AI, crucial for future growth. I think that's undeniable. The question is whether or not I want to be the participant of the investment round, or whether I want to find another place to store my cash in the meantime, and then I'll come back when they're bigger and better and more operationally efficient, and I'll buy them back at a later point. And at that point, they would have already done the investment. We can see whether or not they're operationally efficient. Bless me. Whether or not they're operationally efficient. And at that point, it becomes a better investment. There's less risk. It's a more sure business case. Right now, there's still a lot of uncertainty whether or not they will come out on top, and they will actually manage to monetize the huge amount of capex that's currently being invested into AI. Google Cloud is rapidly expanding with a strong revenue trajectory. Yeah, I think that's still a big revenue driver. Robust user engagement is served, and YouTube highlights their competitive edge. Yeah, I think search currently is quite big. I think more and more people will pivot to AI, but Google has their own AI model, Gemini. So maybe they managed to keep a lot of the users. And then it's still the question, how are they going to monetize it? I think YouTube, I think it's a great platform. I see continued growth there. It's not slowing down. So my perspective, this is still, there's no competitor to YouTube. So this is a solidified mode. Now, if you look at it from a revenue perspective, they continue to grow, but the growth is slowing down. Free cash flow perspective, they continue to grow, but it's slowing down. Return on invested capital is still very good, and actually they managed to increase it recently. Cash to debt is still very good, so they can make their capital expenditures into their AI capabilities, and they have recently bought back a lot of shares. Now, I think they were absolutely cheap, so great business decision to spend cash on buying back your own shares. If we look at it from their latest return on invested capital, it has increased even more to 25.8%. That's what I like to see. The return on equity, the return on assets, return on capital expenditure, all very, very high. Gross margin of 58%. Now, for a software company, that's relatively low. Their operating margins are then very strong, and their net margins are incredibly strong, 28.6%. I think this is the highest one we've seen today. Debt to equity, this is all looking very good. They do pay out a small dividend, which is also very sustainable. Now, let's look at what we have always looked at. Cash in short, yeah, we already know this is beyond positive. Let's say it's 100,000 rounded out. Short-term debt, 0. From a liquidity perspective, perfect. So they can absolutely put this cash to work, invest it into AI. From a cash flow perspective, let's look at the free cash flow. Without looking at it too much in detail, I would expect it to decrease the last few periods. Oh, no, it hasn't. It's still increased. I would at least expect their capital expenditure to grow. That has grown quite significantly. But they still managed to grow their free cash flow. Income-wise, growth, 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 growth. They're not slowing down at all. Woo! Crazy, 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 crazy. They've 5x over the last 10 years. Earnings per share has grown massively as well. Okay, so it's still a great business. The first question, is it a great business? Yes. Then the price. Right now, we want to see the inverse. We want to see it highly overpriced. Let's take a look at our DCF calculator. Let's say best case scenario, they keep investing, but they manage to do well in the AI race, and they keep growing at 20% for 10 years, which is really, 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 really good. Especially given they are already such a large company. If they manage to do this, I'm willing to pay 30 times earnings. Now, let's say they're able to grow 15%, 10 years. I think that's still relatively good given their size, but I would be willing to pay a little less for that. And then for 10% revenue growth, I'm willing to pay market average. And then we want to have a 15% return. It's overpriced by 20%. So yes, right now could be an interesting time to sell, but it's not massively overpriced. If we do it based, we just did the calculation based on their earnings growth. Now, if we do it from a free cash flow growth perspective, it's even more overpriced. And from a dividend, yeah, they barely have any dividend, so this won't massively. Oh, they don't have any dividend at all, so it's still overpriced by about 20%. Yeah, I'm going to be very not optimistic. That's not the word I'm looking for. What am I looking for? Opportunistic. I'm going to be very opportunistic, and I think I'm going to hold on to it a little bit. Maybe we can eke out. Let's see what it is. It's still on a growth trajectory, so it feels wrong to sell right now. So I'm going to add it to my watch list, and probably at the bottom, I might sell 250. Feels like a great number. Could it reach 300? It could, but based on my analysis of how I look at a business, it's not worth 300. So it would be entirely opportunistic to hope for it to go to 300, but it would not be based on any actual analysis and fundamentals, and it would be I would let emotion take control over something that we know might never reach it. And 250 is already a great price, so 250 it is. That's my number. That price I wanna sell. And then what are we gonna buy? What are we gonna buy for it? Now let's take a look at GamMap. This is a company that I'm very interested in. I had some analysis done on this by myself. Let's look at it. So currently it sits at 27.5. If we get some cash out of Google, this could be a great place to store my cash. Now, it ticks every box of our own algorithm. This algorithm looks at every great value investor: Warren Buffett, Charlie Munger, Peter Lynch, Benjamin Graham. It looks at how they bought their stock, how they decided whether they wanted to invest in something or not, what qualities they wanted to see in a business, and whether or not these qualities are met. Financial Fortress looks at liquidity, it looks at operational margins, it looks at R&D margins in relation to revenue, it looks at SG&A expenses in relation to revenue. It analyzes the entire balance sheet from the last 5 to 10 years, depending on how old the business is and how many years it can be analyzed. And it says whether or not, based on the perspective of these great investors, whether or not this company can be seen as a financial fortress. The compounding engine looks at the growth rate of the business, completely separated from the price. So it looks at, okay, based on their revenue growth, their free cash flow growth, their operational efficiency, can they compound on themselves? And as an investor, you want to use compounding your advantage. It's the last great wonder of the world. And this is where you can make significant amounts of cash. Once again, through the lens of all the great investors. And the last thing is entry price. It looks at, okay, given this business, given this price that you're currently paying for it, is this a good price to buy it? Yes or no? Yes or no? And again, through the lens of these great investors. And for this business, all three of these are a check. That's and what does this tell you? If you get three checks, three green signals saying this is a great business, it doesn't mean go out and buy it straight away. It means this is a business to take a look at. We have a stock screener where you can filter on all of these and see if there are businesses that match all three of them. There is never a lot of businesses around that pass all three of these checks, but if you see a business, it's absolutely worth your time to take a look at it yourself. Again, we're here to teach you the process of how to look at a stock. We teach you here how to put your money to work, but it's up to you to do the hard work, and you still have to do the due diligence on this business. You can use our software and you can join our community to make sure this happens. But it's still up to you. Never buy something because somebody on the internet says to buy something. Never buy something because I own it or I'm interested in it. Do your own due diligence, do your own work, and that's where you will make your money and secure your financial future. Now, once again, for this business, 3 question marks. Is it a great business? Can we buy it at a great price? And can we reliably predict it for the future? Great business, given the checks, I'm already leaning towards it could be a great business. So again, what are we looking for? Let's start out what we've been starting out with all day today is their cash position, which is 21,000 in relation to their short-term debt. Short-term debt is 0. Perfect, absolutely perfect. Let's look at their cash flow. Let's increase the periods. We want to see growth and we want to see stability. It has grown. There is a little bit of a decrease here. We see growth, a little bit of instability, but overall we see growth. We don't see any negative numbers, so it's never too bad. But it's not the most stable, but there is absolutely growth. So this is okay. This is okay. Let's look at the revenue. They've managed to increase their revenue year over year over year, except for 2020 to 2021. But they made up for that 2022. Then they continued that growth trajectory. This is looking very well. Now, we've looked at the balance sheet before any of you probably know what this business does. And I like to do it like this, but not everybody wants to do it like this. And the reason for that is I first want to make sure, okay, could this be a great business before I get dragged down in the story? It's very easy for a good story to become a bad investment. And therefore, I want to look at the fundamentals and then take a look at what the business does. Now, Genmac, they make innovative cancer treatments, absolutely cutting edge. They have epcoritamab is for lung cancer, and Rina-S is for for ovarian cancer. And they have 6 other already revenue generating treatments out there. And their business model is focused on developing and commercializing antibody therapies. And they earn money through product sales and partnerships. So this is a biopharmaceutical business. Therefore, they are reliant on revenue streams from their already successfully trialed and FDA approved medication to be sold. And they're also very dependent on their R&D cycle for new medication to be approved for them to generate revenue over. Now, they have a strong edge with an advanced pipeline. They still have some approvals to go through, but most of them are in phase 3, which is at the end of the cycle. And they've shown the ability to deliver effective medication. They have 3 billion in cash. Great. Indeed, it provides flexibility to navigate challenges and invest in growth. Great. Now, research is historically proven to be very, very, very cash intensive, and they have the cash to back it up and to actually get things approved. They also have the cash flow to generate more cash and to keep growing both their R&D line, so they're positioned already very well for the future, and they are on a solid growth trajectory. They reported a 90% revenue increase and a 56% operating profit growth in the first half of 2025. Ooh, perfect, perfect, perfect. They focus on late-stage programs, Rina-S and Akasendimab, suggest they're prioritizing high-potential products to drive future revenue. Mentioned optimistic about upcoming regulatory decisions. Target exit date November 30, 2025. That's not too far away. Most of the time, if these are successful, you see the stock take a little flight. They plan to initiate 3 phase 3 trials for Rina-S by year end, indicating commitment to advancing their pipeline. They have a robust cash position of 3 billion. Recent product approvals and ongoing trials suggest strong future revenue growth potential. Management's focus on late-stage programs indicates a disciplined approach to development. Okay, I'm getting a good vibe, good feel from this. If you look at the revenue growth, again, positive. And the change from the last 3 companies we looked at, the 5-year average is already positive, but last year's average is even more positive. So they managed to increase their growth trajectory. Free cash flow side, this is not entirely the case. We see some ups and downs, but overall, an increase. Return on invested capital is very high. It's in the 20s. That's what we like to see. The cash to debt is absolutely bonkers. Usually, you want to see cash to debt numbers that are a lot lower than this, but because biopharmaceutical companies are very, very cash intensive, and you see that their cash levels are already decreasing quite significantly in the last few years, probably due to their phase 3 trials. And I already did some more research on this business. They've recently acquired another company that's very interested or very interesting for their entire portfolio. I'm not entirely sure what the name of this business is, but what the business does is they create targeted cancer medication, very highly targeted cancer medication. Instead of the old treatment paths that used to nuke the entire body and hope the patient survives longer than the cancer, this business allows them to create medication that can be very, very personalized for the patient and highly personalized for the cancer that the patient is experiencing to deliver treatment that detects only the cancer. This is a huge improvement to both the patient patient empowerment and the way the patient receives their treatment. It's a lot less destructive than the old treatment paths. There are other medications that already try to do this as well. We've already advanced in the medical field quite a bit, but they can add this to their own product portfolio, and they can build on this quite a lot more. And they have the cash position, they have the cash flow, they have the track record to continue creating great drugs, great treatments. And cancer, I think cancer is quite a big problem for us as we get older and older and older. We are very, very likely to experience cancer at some point or experience a tumor. You're never sure if it's a good or a bad tumor, but you're very likely to, if you get older, to get a tumor. And if it goes bad, then you want the right treatment. And I think the entire market is going to grow, so they are in a good market. And they have a right strategy, they have a good business, they have the right cash position to actually do the research to get the revenue generating medication. And on top of that, they also have share buybacks. So even if they don't go too fast, last year they bought back almost 2% of their shares, which is also very, very good. Now, if you look at their operational efficiency, gross margin of 95.42, that's absolutely massive. Operating margin of 31, net margin of 36. This is the best business so far that we've looked at from an operationally efficient perspective. And we have looked at software companies, and this has absolutely outperformed that. That's insane. The last return on invested capital was a little bit lower, no longer in the 20s, but in the high double digits. They don't have a dividend. Debt to equity is great. Again, cash to debt, it's being flagged as way too high, but for a biopharmaceutical, we can explain why it's high. Now, let's see. I think we have decided the company, this is a great business. Now let's look at the price perspective. Before we put in our numbers, let's look at the exit multiple that you're paying for the earnings, which is 12. This is relatively low. And I think biopharmaceutical companies are seen as a lot riskier. So most people are willing to pay a lot less for them. If there is another business that comes out or another drug that has a better treatment or has a better efficacy than the drug that Genmab produces, your whole business model or your whole revenue driver is basically gone. Now, the chance of this happening is not zero, but for biopharmaceuticals, this can happen on a whim, or you can have a drug that's currently being researched in phase 3 and it can fail, and then you have invested a lot of cash into it. It's very cash intensive, and then you've basically thrown it all away. You need to acquire new cash, probably goes along with giving out more shares. The reason why I like this business, they already have other revenue driving medication, so I'm not too worried about them, at least for the short term. Now, revenue growth, let's say they continue to give it a 25, then we have 15, and then let's say they grow a little bit less. No, I think I want a little higher variance. Let's say they manage to grow 30%. Could they do that? How big is their income currently? Yeah, 21 billion. They're already quite big. So let's say they Yeah, I think 25 might be too high. Let's do it like this. And for this, I'm willing to pay 25, 20. No, let's not be too generous here. Let's be a little cautious. I do want 15% return. I'm putting the multiples a little lower, even at 20% is quite high. The market is also putting a lower multiple on it. So I'm being cautious and following what we see. And there is a massive upside. There's an absolutely massive upside. I think the price currently was around 30. Yeah, so we have a great business. We can buy it for a great price. And I think from a reliability perspective, drug trials are finicky, historically finicky. You never know if something is going to succeed, when it's going to succeed, and how well it's going to succeed, and how well it's going to do in the market. That's something that we will never be able to predict. So from a reliability perspective, that will always be an unknown. However, they can deal with that unknown because they have a very high cash position in relation to a very low debt position. This makes them very attractive. They also have a very steady cash flow that continues to increase. So they are already very operationally efficient, even if their new drugs fail. So to me, great business. If we sell Google, this is one of the top contenders to buy. Next up, I think we're going to take a look at one more question and then we're going to call it a night. And that's Accenture. Where are you? Accenture. We had a specific community request to look at Accenture. I don't know if you're still in the chat, but I'm interested to see what you make of it. Once again, we look at it through three questions. Is it a great business? Can we buy it for a great price? And can we reliably predict it for the future? Now, from a business perspective, let's start out again with what we started out with every time so far, their cash position in relation to their short-term debt. They have about 5,000 or 5 billion. All these numbers are a million of cash on hand. Look at it for their short-term debt. Yeah, they have 5 times more cash. So again, that's met. Let's look at their cash flow. I always like to increase the periods to see if it's stable and if it's growing. It started out at 3.6. Growth, 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 growth. A little bit of a dip. Stable, absolutely. Growth. Last year, no. Every year prior to that, yes. So, okay, that's okay. Okay, let's see in 2025 if we see continued growth or not. First quarter was terrible, but it usually is. And it was less terrible than before. The next quarter is even better. No, this is first quarter of 2024. Where's 2025 Q1? We're missing some data here. Okay, let's disregard that. Let's look at income. Annualized. Is it stable and is it growing? It has doubled over the last 10 years. Not massive growth. That's not massive growth, but there's definitely growth there. And we also see that it's relatively stable. I always like to look at their earnings per share as well. And they've managed to also, more than double that. So that's quite good. They do pay a dividend. Seems very sustainable. If we look at their cash position, again, it's very good. If we look at their operational efficiency from gross margin perspective, they're a lot less interesting than all the other businesses. The reason why is because a lot of their revenue is dependent on their big consultancy firm. And they basically sell consultants by the hour. So every time they put a consultant away and they receive the hourly rate, probably half of it, maybe more than 70% is maybe going to running the business and to the consultant itself, and then they get to keep 30% to run the rest of the business, and then 15% of that is turned back into is their operating margin, and then a little over 10% is their net margin. Not great. Having a low net margin makes your business relatively unreliable. Having low gross margins does the same, because if your revenue drops, revenue can drop rather significantly. They still have to pay their consultants. They still have to pay all the leases on the buildings they own. They still have to pay other operational costs. They can't decrease their costs as fast as the revenue decreases. If you have higher margins, you can take a bigger hit before it becomes a negative cash situation. If you have smaller margins, there's less room for error. And here we see less room for error. So if this business turns around in a bad way, they can be hit quite significantly. Now, what is the likelihood of that happening? We can look at it from the predictability section. If we look at it from whether or not it's a great business, I think these margins for consultancy firm are okay. Return on invested capital is great. Their revenue growth is slowing down. Their free cash flow growth is slowing down, is even negative. The return on invested capital is huge, but also slowing down. Cash to debt has taken a hit, but still very good. And they do buy back some of their shares. So far, I think it's an okay business. It's not great. Yeah, they could provide consulting and managed services, focus on technology and AI. Their business model is built on large-scale transformations for clients. They earn money through project fees, management services, and strategic partnerships. Now, project businesses can be very fickle. They can have a lot of projects and be extremely profitable, generating a lot of cash. And then the next day, there are no projects. People cancel their projects. And there can be relatively low income. They can have a few bad years before they climb back up again. So they can be really cyclical. That's what I'm trying to say. Competitive advantage. It's a big name. They have a strong moat due to its skill and expertise. That's very true. They're investing heavily in generative AI. Booking as 1.5 billion. Their commitment to training 80,000 data and AI professionals by 2026 shows they're serious about maintaining this edge. Yeah, everybody is investing in AI, but they're positioning themselves well for the future. The company is experiencing solid compounding momentum. If we look at our algorithm, it says they don't meet the strict criteria from our biggest value investors and how they would look at whether or not a business has a compounding ability. They don't see it. The management themselves do say they experience a solid compounding momentum. Their revenue hit 70.7 billion, exceeding expectations. Now, that's always nice to see. Their operating margins expanded to 16.8 and EPS grew by 12%. This consistent growth indicates a healthy business trajectory. Okay, so they're not seeing sloth. They're not seeing the cyclicality yet. Management is optimistic about future growth, particularly in managed services and generative AI. They have raised their full year revenue outlook. Okay, however, they acknowledge risks from economic uncertainties and procurement slowdowns in the US federal services. Yeah, this is what I was already hinting at. If this keeps slowing down, then their entire project base for them to generate revenue of is basically gone. And then a good story can turn around quite quickly. Yeah, I'm not in love with this. I think it's an okay business. They're doing well. From a price perspective, I think you're paying about, yeah, for this, yeah, I think it's relatively expensive even though recently it has dropped in the last 6 months by 25%. I still think you're overpaying. Let's put it into our DCF calculator. Your business record shows about 10% growth. Let's put it as a normal case for 15 multiple. Again, for 10% business growth, you get a 30 multiple. I think that's way too high. Best case, let's say they grow 15, and worst case, they grow just 5. Projects dry up. I want a 50% return. Let's hit the calculate button, and it's overpriced by about 50%. So no, you're not getting a great price. From a predictability perspective, currently they seem to be doing well, but I think this can turn quite quickly based on factors that are outside of their control. Because of their low margins, they can be their cash position can be hit quite significantly, and what looks to be a good story can turn around relatively quickly. Now we see the stock price dipping as well, so I think the market agrees with me, and I don't see a reason why the market is wrong. So Accenture for me is a pass, and I'm actually going to remove it from the watch list. All right. Anybody else want to take a look at a certain business. Now is the time. I don't see any requests coming in. Then, before we leave you, there is one more tip, and that's the book tip. Let's redo that. There's one more tip, and that's the book tip. It's a book by Peter Lynch. It's called One Up on Wall Street. Peter Lynch ran the Magellan Fund from 1977 till 1990. That's 23 years, and it's still up to date, the best performing fund for such a large period of time. And Peter Lynch, in his book, he aims at the retail investor, and especially somebody who's interested in stock picking. He has a great view on how you as a retail investor can find your edge in the market and actually outperform every other fund manager, because you do have an edge. And he talks about how you can find it, where you can find it, and what to look out for. Another interesting thing about Peter Lynch, a lot of the Wall Street lingo that's being used today, a 10 bagger, a 100 bagger, that's the kind of stuff that he came up with. I think even Mr. Market might something. No, I don't think he invented Mr. Market. But a lot of the Wall Street lingo comes from Peter Lynch. Peter Lynch, the 10 bagger, the 100 bagger. 10 bagger is a stock that goes 10x. So you 10x your investment, and 100 bagger is 100x. It's fairly simple. So for the beginning retail investor or even experienced one, Peter Lynch, One Up on Wall Street, absolute must read. All right, and that's it for us tonight. We'll be seeing you again next week, where we'll be talking about everything that's going to happen, that will happen, that we don't know yet next week, and all the stock market news. We'll be looking at a few new stocks to analyze. If you have any suggestions, please let us know. We also do some portfolio review. So if you want us to look at your portfolio, give you some insights, some tips on how to manage it well, or maybe roast you for the bad investments you made, please send us in your portfolio. Once again, if you're interested in our software, go over to marketdaddy.ai. You can try it out for free for 7 days. And after that, you can use it for less than a cup of coffee a day. So it's absolutely a no-brainer. Thank you for watching, and we'll see you next week. Bye-bye.